Okay, so what in the world just happened in the financial markets? We saw this sudden, really sharp jolt that kind of came out of nowhere. So let's figure out what's really going on. Let's break it all down.
Just look at this. We saw this incredibly dramatic split in the market. In a single day, gold just shot up 6.5%. That's a classic sign of investors running for safety. But at the exact same time, stocks, bonds, even crypto, they all took a nosedive. Now, this isn't your average up and down day. This tells us something specific shocked the system.
And that brings us to the big question on everyone's mind, right? Was this whole thing driven by a legitimate panic? A sign that something is seriously wrong? Or is this sharp drop actually creating a brand new opportunity for people who can see what's really happening?
Well, it turns out the source of all this fear wasn't some big, flashy headline you might have seen. The real trigger, the thing that started this chain reaction, actually goes back to a very specific corner of the global market: Japanese bonds.
So here's what kicked it all off. The interest rate or the yield on Japan's 10-year government bond spiked to its highest point in 18 years. And you might be thinking, okay, Japan's bonds, why should I care? Well, it's a huge deal because for decades, Japan has basically been the world's anchor for low interest rates. When that anchor suddenly gets pulled up, it sends massive shockwaves through the entire global financial system.
And that right there is what immediately sparked fears of something called financial contagion. It's this idea that trouble in one major economy, in this case Japan, doesn't just stay put. The fear spreads like a virus, causing a domino effect in markets all around the world, especially in a place like the United States.
And we saw that fear turn into reality almost instantly. The U.S. 10-year bond yield reacted right away, blowing past a really important technical level of 4.19% and just kept climbing. This is financial contagion playing out in real time, and it's exactly why stocks and other assets suddenly looked a whole lot riskier.
Okay, so we've nailed down what caused the panic. But now for the million-dollar question: was the panic justified? Was it an overreaction, or is the danger really as bad as that sudden market drop made it seem?
To get to the bottom of that, we have to do what we always do. We've got to ignore the noise and actually look at the data. We're going to check 3 key vital signs of market stress to see if they're actually flashing red. All right, let's break this down. First up, bond volatility, the MOVE index. Yeah, it popped up, but look, the overall trend is still pointing down, so low danger there. Second, stock volatility, the VIX, which is basically Wall Street's fear gauge. It definitely jumped, but it's still way below the levels you'd see in a real crisis. It's an alert, not a full-blown alarm. And finally, the risk on corporate debt? It's stable. The trend is still down, so no big danger signs there either. Now, just as the market was trying to digest all this fear, a new player stepped onto the field. And this is a player with the power to completely change the rules of the game. We're talking about central banks. This development totally shifts the entire calculation for investors.
And this, folks, is a game changer. We've learned that some pretty serious international pressure is being put on Japan's central bank. The message is crystal clear. Get your rising bond yields under control before this thing spreads any further. And let me tell you, that's not just a friendly piece of advice. It's a massive signal that the world's policymakers are getting ready to step.
So what does that actually mean? Well, it means the Bank of Japan is almost certainly going to have to do a 180 on its recent policy. To get those yields down, they're going to have to start buying bonds again. And that process pumps fresh money, what we call liquidity, right back into the financial system. It's the exact medicine you need to calm things down.
Okay, let's take a step back and put all these puzzle pieces together. You've got the initial scare coming out of Japan, then you've got the data that shows the panic was probably overblown, and now you have the expectation that central banks are going to step in. This leaves us with 2 totally different ways to look at what just happened.
So on one side, you have the bear case. The panic was real, and this is the beginning of a bigger downturn. But on the other side, the bull case is looking a whole lot stronger. Remember those key risk meters we checked? They are not flashing red. And maybe even more important, it now looks like central banks are getting ready to pump in more cash. All of that points to this being a temporary scare, not some fundamental break in the market.
So when you weigh all the evidence, the verdict seems pretty clear. The most likely scenario here is that this was a healthy, okay, maybe a little scary, but a healthy correction inside of a bigger uptrend. The panic was based on fears that are already being dealt with. All the signs are pointing to the market's main upward trend still being very much alive. And that leaves us with one final, pretty provocative thought. Now that the fear is starting to fade and it looks like the central banks are going to act, maybe the biggest risk isn't another drop. Maybe, just maybe, the real risk is being stuck on the sidelines while the market rebounds. It's something to think about.